If you've ever put more and more money into the same type of deal just because it worked the first time, this video is for you. I want to walk you through a story that shows how overexposure happens quietly and what you can do to protect yourself before the next shift hits. Hey, my name is Kent. I've been investing in alternative assets for over 20 years now, from flipping houses to private equity and now managing a diversified fund. But before all that, I was just like most investors. I was following what seemed to work until it didn't. I've made the mistakes and now I help others to avoid those very same mistakes. Let me tell you about someone I know. We'll call her Dana. Dana, she's unbelievable. She built a successful healthcare business, and after years of hard work, she was able to sell it for an awesome exit. I mean, she did what many smart, disciplined people do. She started looking at ways to grow and protect that money that she had made in that exit. And at the time, everyone she knew was talking about multifamily real estate. Sounded like a proven path. And soon she did her research and she found a really good operator and she got into her first deal. And sure enough, that deal smoked. For the first 18 months, everything was great. Cash flow was coming in, the value was going up, the market was hot. So, what'd she do? She reinvested and then she reinvested again. And before long, 80% of that money she had allocated for alternatives was in multifamily. Now, she didn't realize it then, but what she had started as a smart move had turned into a concentrated risk. And that's exactly what happened when interest rates started climbing. The refinance timelines shifted, rent growth slowed down, operators stopped distributions. Even one of them even triggered a capital call. So that's when she reached out and called me. Now, she wasn't in desperate or panicking, but she was really worried. She was tired of hearing the excuses. Just wait a little bit longer. And she was tired of feeling like she actually didn't know what was going on in her portfolio. And most of all, she was asking the question that matters most: how did I end up here? And I told her, this is what I've seen over and over again, including my own past. So we have to look at the past to learn what to do in the future. Most investors, they don't overexpose themselves because they're reckless. They just do it because something felt safe, and truly they just got really comfortable. And that's the danger. When something works for a while, it's easy to keep going back to it. It's easy to keep allocating money there, and suddenly you don't realize it, but quietly the whole thing is riding on one asset class or one market cycle or one strategy. So here's what we did: we didn't tear anything down, we just started widening the lens. We talked about how she could build across different cash flow profiles, across different classes, different risk structures, and different market behaviors. And now she's in a much healthier position, not just because of what she's invested in, but because she no longer needs everything to go perfectly right in one place. That's what I want to do for every investor I talk to: more stability, more clarity, and more control, and a whole lot less frustration and surprise when the winds shift. Because you know what? They always do.